Welcome to the deep dive. Today we are digging into something really specific, something almost legendary in these circles, the one-shot, one-kill model. This comes straight out of the 2016 core content, specifically month '07. And our mission here isn't just to, read a manual, it's to get inside the why of it all. The institutional timing, the weekly flow, basically where the smart money is playing.
And we have to start with a disclaimer, really. This OSOK model is not for beginners. It's a refinement. It absolutely requires you to be fluent in the macro concepts from earlier in the mentorship, and especially things like the IPDA data ranges.
IPDA, right. That's the 20, 40, and 60-day look-back periods.
Exactly. The Marcus memory. This is all built on top of the position and swing trading modules.
Yeah.
OSOK is where you take all that big picture knowledge and apply it for, well, surgical weekly entries.
And before we get surgical, we absolutely have to state the obvious. Trading futures and options, it involves massive risk. What we're discussing here are general market concepts, not trading advice for you specifically. And you should never, ever trade with money you can't afford to lose. Past performance doesn't guarantee a thing. Okay, with that said, let's get into this. One shot, one kill. It sounds incredibly aggressive, but the philosophy behind it seems to be about limiting your goal. Why not just go for the whole weekly range?
That is the perfect question, because that's the whole insight. The goal is precision, not grand theft. The material sets a really specific target. At first, you're only looking for maybe 30 to 50 pips a week. That's
30
it.
to 50, that sounds almost too small.
It does. But it's about probability. You might graduate to 50 to 75 pips, but the instruction is clear. You are not aiming for more than 100 pips a week with this model. The whole point is that a small, highly probable, low-resistance chunk of a move is so much more attainable than trying to ride the entire thing through all the, the violent chop and consolidation.
Okay, so if the goal is that precise, that surgical, our tools have to match. We can't be looking at a one-minute chart for this.
Absolutely not. No. The OSOK model is framed entirely from the top down. Your main canvas, your master chart, is the 4-hour. That's where you define the real levels, the major PD arrays that the institutions are actually watching.
And execution.
Execution happens on the 1-hour chart. Anything below that 60-minute time frame just gets way too noisy. You fall into pure day trading or scalping,
Right.
And that's not what this is.
So why the 4-hour? What makes it the magic filter?
It just smooths out all that intraday noise. It lets you see past the little knee-jerk reactions and identify the structural levels that are going to dictate the direction for the entire week.
Okay, let's define that term because we're going to be using it a lot. A PD array. In simple terms, is it basically a market landmark, a spot on the chart where price is either drawn to or reacts violently away from?
That's a perfect way to put it. A premium discount array is a historical landmark, an old high, an old low, a gap. It's a place where a huge chunk of institutional orders were placed before. So when price comes back to that spot, you expect a reaction. And the whole idea of alignment is that your 4-hour setup has to be nested inside a major monthly or weekly PD array.
So you need the highest time frames to give you permission first.
You need their validation, yes, before you even think about looking for an entry on the 1-hour chart.
And if you get that alignment, the goal is a big one. The ideal trade, it says, seeks a 3-to-1 risk-to-reward ratio.
It does. We're not hunting for 1-to-1 coin flips. The edge is built into finding that highly efficient setup, which leads us directly into the most important part, timing.
The when. This is where it gets really interesting for me. The idea of an institutional schedule. The idea that we can anticipate how the Interbank price delivery algorithm, the IPDA, structures the week to create these openings.
This is the weekly time law, and it's probably the most powerful concept in month '07. There is a 76% likelihood that the absolute high or the absolute low of the entire trading week will be formed between Monday and Wednesday.
76%.
Yes. It's not random. It's market makers setting the stage. They engineer a move in one direction, the manipulation, to collect liquidity before they start the real move for the rest of the week, the expansion.
That 76% rule it's a huge edge. It gives you a strong directional bias by Wednesday afternoon. But I have to ask, what about the other 24% of the time? What if the high or low forms on a Thursday? Does the model just break down?
That's a great question. When it forms later, it usually signals a really aggressive continuation of the bigger trend, not the kind of reversal or retracement we're looking for with OSOK. So for this model, if that structure hasn't formed by Wednesday, the probability drops a lot. And the disciplined trader just, they step aside and wait for next week.
Wait for the A+ setup.
Exactly. Now, about confirming that move. If the high that was made between Monday and Wednesday gets broken later in the week, That is your confirmation of an aggressive buy program. You expect price to expand up to a higher target.
And the opposite if the low breaks.
And conversely, if that Monwed low breaks, you have confirmation of a sell program. The path of least resistance is now down to a lower objective. The move away from that early week extreme tells you everything.
And month '07 gives us the actual blueprints for this manipulation, the market maker templates. Let's dig into those.
Okay, so viewed on a 60-minute chart, there are two classic examples that really exploit this Monday to Wednesday window. First is the classic Tuesday low of the week. You'd expect this when your higher time frame bias from the monthly and weekly is already bullish.
So the market already wants to go up.
It wants to go up. But the algorithm will engineer this sharp drop on a Tuesday, specifically drawing price down into a key discount PD array. Think of an old weekly low or a big liquidity pool. They're hunting the stops of early buyers, and it lets the institutions load up on huge buy positions at a great price right before the real move starts. The rally after that is usually, well, vertical.
And the second one, the Wednesday reversal, that one feels like it's often tied to news.
Very often, yes. The Wednesday weekly reversal plays out around a high-impact news event. The market will first run an old low or some really obvious retail support level. It triggers stops, creates a bit of panic.
The classic stop hunt.
The classic stop hunt.
Right.
Price drives down hard below that level, looks like a breakdown, and then it just reverses on a dime as the news is discounted and the real institutional direction kicks in. And you'll often see that reversal target specific Fibonacci extensions of that initial manipulative move, like the 1.27 or 1.68 level. Those aren't magic numbers. They're just algorithmic profit-taking points that often line up perfectly with a higher time frame PD array.
It sounds like these reversals are where you can really see the institutional hand at work. A fast, violent move against what everyone on Twitter is probably screaming about.
That's it, exactly. The source material explains that these are often overlapping disciplines. A daily swing trade setup might align perfectly with a short-term reversal template. The key thing to watch is the speed. Price moves so aggressively from a daily premium back to a daily discount, but, and this is critical, it's unwilling to leave the larger long-term premium market if the overall institutional flow is still bullish. It's a quick, violent reset before the main trend continues.
Okay, so let's shift from timing to actually doing it. Execution, we've got our bias, we've seen the manipulation. How do we define our target? Where do we get out?
You have to frame the weekly range first. That's job number one. You find the distance from a monthly or weekly discount array. That's your floor. And you measure up to the next major weekly premium array. That's your ceiling. That total distance is your maximum potential for the week. The OSOK trade is looking to capture, say, 75 or 80% of that range.
And the entry itself.
For the entry, you're zooming into that 4-hour chart. You're looking for those institutional footprints. We're buying at discount arrays, a bullish order block, a fair value gap, a rejection block.
Okay, hold on. Define an order block for us, because that's a very specific term.
Sure. A bullish order block in a bullish scenario is simply the last down close candle, the last red candle, right before a huge explosive move up. The theory is that institutions were accumulating their buy orders on that final little drop. So the opening price of that down candle often becomes the precise entry point when price revisits it.
That makes the entry crystal clear. But let's talk about managing the trade once you're in. The rules for taking profit and managing risk are, they seem really strict.
They're non-negotiable. They're designed to protect your capital, but also your psychology. Rule 1. You wait until prices moved 1/4, 25% of your total objective before you even think about taking profit.
And you only take a small piece off them.
Just a small piece.
Yeah.
20 to 30% of your position. And rule 2, and this is where so many people mess up, you only move your stop loss to break even after that first profit is taken, never before.
Never before.
If you move it to break even too early, you're just asking to get stopped out by one of those institutional whipsaws that are designed to do exactly that right before the real move goes.
I can just feel the psychological pressure there. You're in profit and you just want to make the trade safe. This forces you to trust your analysis.
You have to trust it. And rule 3 is the exit. You take the rest of the position off at your main premium array objective, or once you've captured 75 to 80% of that range we defined. After that, if you have anything left on, you only trail your stop below the most recent 4-hour short-term low.
And there was a warning in there about the 50% level, right?
A huge warning. The algorithm will very often make a specific run for stops, right around the 50% equilibrium level of the range you're trading in. It's designed to shake out weak hands. If you trail your stop up too tightly, too fast, you're just volunteering to be their exit liquidity.
Wow, that's an incredible level of detail. Okay, let's make this practical. What's the homework? How can someone listening take these concepts and actually apply them?
The practice has to be about pattern recognition, not just, ticking boxes on a checklist. So homework one, I call it defining the master blueprint range. Pick a pair, go to the monthly chart, define the last major price swing, but use the candle bodies, not the wicks.
Bodies, okay.
Note the highest high and lowest low of the bodies in that range. You need to internalize that the algorithm is contained and operating inside that specific blueprint.
Got it. What's next?
Homework 2, weekly template backtesting. Go back over the last 4 weeks of trading on your chart. Mark out Sunday's open to Friday's close. And for each week, document. Did the high or low of the week form on Monday, Tuesday, or Wednesday? Then check for the confirmation. Did the break of that early week extreme lead to that big aggressive expansion move? See that 76% rule in action.
Okay, and the third piece.
Homework 3, the order block entry drill. Find a pair where your monthly and weekly bias is clearly bullish. Then go to a 4-hour chart and find a recent down close candle, a bullish order block. And then practice identifying the whole trade. Entry at the open of that down candle, stop loss right at the low of the candle, and target the very next weekly premium PD array above. And then just calculate the risk to reward potential. See if it hits that 3-to-1 mark.
That's a fantastic structured way to practice, from the macro all the way down to the micro entry. So the big takeaway here really is short-term trading, when done this way, isn't about scalping for a few pips. It's about using the highest time frames, the monthly and weekly, to see where the market is going on a massive scale, and then just using the 1 hour and 4 hour to pick that one single low resistance entry point that lines up with the institutional schedule you already anticipated.
That's the entire framework in a nutshell. You focus on the left side of the chart, the history of the patterns, to forecast the right side of the chart. Right. If you believe the marketplace is engineered, which this material absolutely contends, then these structural patterns have to repeat. Mastering this is about building an efficient, repeatable process that relies on procedure, not emotion.
So I'll leave you with a final thought on this. If the market really is drawn to liquidity like a magnet, then knowing that the weekly higher low forms 76% of the time between Monday and Wednesday gives you this incredible foresight. It lets you anticipate when the market is most likely to go hunting for all those hidden stops, giving you a huge directional edge before the move even gets going.